Recession or no recession? That is the million-dollar question right now, and we'll get into it. I'll show you where I have some very specific concerns. But I truly believe that as traders, the charts are really what's going to hold the key as to what this market does and when. So welcome to the Trade Brigade Weekend Show, where we'll dissect all of the data points and build a logical trade plan. My name is Matt, and if you're new here, hit the thumbs up button and subscribe. For additional resources, check out the links listed down below in the description, and stay tuned until the end of today's show. I've got 3 additional trade ideas to share with you that you won't want to miss. With that said, let's jump right into the charts. So kicking things off on the SPY weekly time frame, talking about candle structure and location as we always do. In terms of structure last week, I wouldn't really classify this as a solid green-bodied bar, but I also wouldn't call it a bearish inverted hammer. So let's acknowledge that there was some sell-side pressure in the upper wick there as we were exploring blue sky territories, but we've also got ourselves a pretty strong close towards the upper third of the weekly range. So structurally, buyers are in control. If we're thinking about location on the bar-to-bar count, we've got a very meaningful higher low, as well as a higher high paired with a new all-time high close on the weekly chart. So the buyers are definitely in control of the weekly bar-to-bar, as well as the overall structure. Of course, this breakout here is pretty meaningful. So with this higher high and the upper wick, we know a weekly higher low could emerge, but the concern I have on the weekly time frame chart is if this were to turn into a look above and fail. So what does that mean? And I'm not saying that this is going to be the most likely path, but it's my concern on the higher time frame. If we come back down underneath the breakout point, which we can clearly see was resistance once, resistance twice, and we just broke out through it. It's 565. If we break back down underneath and find a lower high underneath, that's where I would say, okay, it's very possible that the weekly trend changes here and we're in store for some more bearish outcomes. Why would that be the case? Well, because it raises the question of why on a blue sky breakout with technically no resistance overhead, were the bulls unable to find continuation? Why are prices coming back down into a range that's more familiar? That would be more of a bearish takeaway, right? So this lower high, when and if it happens, is where I would change my tone on the higher time frames. The other thing to point out here is that the breakout, and we'll see this on the daily chart and the daily closes, wasn't really euphoric into these blue sky territories, and we don't have a ton of room here to navigate a higher low that would ideally be above 565. If we look at previous examples of breakouts, let me go a little bit further back here. So number 1, here was a meaningful breakout. We had much more room to find a higher low over the previous pivot high. If you look at this sort of over here, this one was pretty close, and you can see that we had to do the dance for a couple of weeks around that level. So is it possible that we could still find a higher low even if we're back down underneath this breakout point? The answer is technically yes, and I would lean into the Fibonacci's and the anchored VWAPs for this. So this would not be ideal, but it is possible to find a higher low somewhere around 555. 555 is this level right around in here, and it represents the bottom of the 2-week balance from this area. We'll see that clear as day on the daily time frame chart. But let's see how that compares to some Fibonacci's from the lows up to the highs. This is slightly below. So if we were to hold 555.50, technically speaking, this turns into bull flag consolidation and we'll look for upside. I would be more concerned about the downside rejection if this pulls back to 555 and once again, more meaningfully, finds a lower high on any subsequent tests of 565. So the concerns, we have the possible setup for it, but we're not there yet. I'm not trying to sound the alarm and say, oh my goodness, short this market into the ground. I just want you to be aware of what I'm thinking about as we get this very lackluster breakout here into blue sky territories. It's bullish until proven otherwise, but I'm trying to give you the framework ahead of time. Let's come on in with the anchored VWAPs on the weekly time frame. We're above the entire cluster, and if we were to move underneath 555, you can see that the cluster is here, confluence with the 38.2. So if we were to hold that, I would still be willing to give the weekly chart an opportunity for a higher low, but you better believe I'll be watching like a hawk any subsequent tests of the 565 to see whether or not this will ultimately turn into a look above and fail. Let's go ahead and throw on the volume profile on the weekly time frame, and we'll zoom out here. And of course, as we're breaking out into blue sky territories, it shouldn't be a shock that we're pushing away from the high volume node into literally uncharted territories. While we're still zoomed out, I do want to point out as well that the Fibonacci extension from the cup and handle has been achieved. The target has been hit. We know that we were really looking closer to 570 there. That's kind of where the upper wick is starting to step in. So again, I'm not calling for this to immediately send markets all the way back down to like 500, but is it a reasonable place for the market to pull back a little bit from? I think the answer is yes here. Let's drop it on down to a daily time frame chart. Let's get a little bit more granular and firstly evaluate this week's expected move. If you're not familiar with this study and to get this range right here, check out the video tutorial in the top right-hand corner. If we're contained by the upper bound, the number's at 575.92, implying a new higher high in the daily trend count, as well as a brand new all-time high. If we're contained by the lower bound, the number's at 560.58, and I would argue that that's a big time higher low from here to here. There really wasn't much of a meaningful hourly downtrend in this multi-day consolidation, lackluster sort of attempt at a breakout surrounding the Fed, right? So this is certainly an opportunity for a higher low to be found, and that's clearly above the line in the sand that we were just describing at 555.50. The daily trend, of course, is up, making this brand new higher high. You can say that we have lows, maybe soft higher lows in here, and this is an opportunity for a pretty important higher low coming from the highest high in the trend count on Thursday. You can start to see how, once again, the candle closes on a daily basis really are not all that strong, which is where some of the concern steps in. But as of right now, on Friday at least, we are printing a daily hammer. That's the structure right here, which is holding up over the previous all-time high and clearly outside of and above the entire 2-week balance that we were just referencing. So the picture-perfect outcome here on the daily chart is a sustained hold up and over 565.25, 566. We'll see that on the hourly in just a second, for a rotation into the all-time high and possible continuation beyond that into blue sky territories. If the market pulls back a little bit further than that, it wouldn't be the end of the world, noting that we still have this area right here, that 555.50. We just talked about it on the weekly chart. Would really be looking for buyers to step up at this level, offering a big time higher low here. And then, as we mentioned, right from there, the key continuation is that you would need to get right back up through the previous all-time high resistance zone without stopping, maybe find a higher low above, and then look for continuation in the upward direction. If you're bearish on this market, what you'd like to see is the hammer candle from Friday fail. You'd like prices to come back down into this balance range, maybe find some semblance of support here, but then reject underneath 566, 565 for a lower high to be found from here to here, which would start to indicate the possibility of a daily trend reversal. Once again, we're not there yet, and I do like the indication of the hammer candle on Friday respecting this as possible support from the previous all-time high. Again, I'm trying to arm you with the situations prior to them happening. Bullish until proven otherwise is the current look on the daily. Let's drop it on down to the hourly time frame chart, and let's really start to dissect what I was talking about the lack of euphoric breakout into blue sky territory. So the first attempt to move beyond the previous all-time high was actually ahead of the FOMC announcement. We opened on a gap up. It was very lackluster. We tested new highs and then closed back down here inside of the prior range. That really wasn't all that exciting of a move on that Tuesday session, and if anything, would imply that new money buyers were not stepping up in the market. Let me zoom in a little bit further on this as well. Here we go. So new money buyers here on Tuesday weren't really stepping up. We got a second opportunity at that on Wednesday's Fed move when we got a break to, again, a new high relative to Tuesday's high. But where did we close? Pretty weak, back down on the lows and underneath the 2-day high breakout point from Friday and Monday of last week. So that really wasn't indicative of new money buyers getting involved either. On Thursday's massive gap up, again, did we get a gap and go? Did we get continuation and new range expansion to the upside? The answer is no. I mean, we technically came in, we closed the gap a little bit, and we did end up going sideways near the highs, so you could call that price acceptance up here. But it doesn't strike me that new money buyers are really getting involved in an aggressive fashion. And then on Friday, right, you open sort of directly on the low of the Thursday session, chop around and somewhat hold that for the daily hammer we were just describing. But I wouldn't call this like the best display of strength from the buyers near this level. I mean, a more severe reaction would have looked like, okay, pullback test, higher low over the opening print into the afternoon with a weekly close near the highs of the weekly range. It just simply didn't happen. So as we're thinking about the hourly trend, it's still technically up. I mean, we have lows, higher lows, equal or higher lows here, higher lows here. We're coming from the highest high. If this is going to turn into a double bottom, perhaps we want to have this neckline area in the chart right around in here. Let's edit this together. We know that we like round numbers only up here in the penthouse at 6 or sorry, 568.25, if we could read, there we have it. If we get up and over that level, I would continue to maintain more of a bullish stance, looking for the all-time high and continuation in the upward direction. If you're chopping around in here, I really believe that that's a threat for the possible look above and fail, where any subsequent trades that look like this are certainly a short opportunity to take risk reward in the downward direction that looks something like this. Now, are we bearish looking for the market to fall apart? Absolutely not. What did we already describe on the weekly chart, on the daily chart, right? There's an opportunity for a daily higher low and maybe even a weekly higher low at 550. So if this trade right here, consolidation, then a breakdown lower high unfolds, I would probably look to start being a little bit more aggressive on the short side, at least intraday for scalps, underneath 562.50, noting that we could rotate all the way back down to the bottom end of the daily range at that 555.50. When we get down here, I'm absolutely thinking about double bottoms on the hourly, inverted head and shoulders, simple hourly hammer candles down here, anything that would start to suggest buyers are stepping up for a higher low at 555.50 is very attractive. The biggest nail in the coffin, if the bears are going to come out of the woodwork and say, you know what, we're going to reject price off the all-time high, this is what the bears want to see. So you get your consolidation, break, lower high in range, and if there's no stopping, if there's no semblance of support at 555 and we get a lower high underneath that level, oh my goodness, prepare. Now we have trapped overhead supply. If we zoom back out further, we have trapped overhead supply. We never really had new money buyers stepping up in here. That would be a large cause for concern. Lower high price acceptance underneath 555 from the hourly perspective. Once again, I'm not saying that that's necessarily the highest probability here. I do still think that we have bullish indications across the board, but that's something to possibly prepare for if the look above and fail becomes a reality, right? And the pattern, of course, that's sort of in play there, if I just do this, and even just for these scalps from point A down to point B, the pattern, of course, is left head, right shoulder, break the neckline, and you're looking for that pullback, right? So that is what we're thinking about to the downside if pullbacks emerge. We already talked about upside. The upside usually just takes care of itself as we're dealing with blue sky territory breakouts. So manage risk to the upside. Try not to chase the highest highs when we're in blue sky territories, but the weekly expected move might act as a reasonable target up here closer to 575. Let's take a quick glance through the lens of Fibonacci's. Of course, this move from the low up to the high is the same thing we were just looking at on the weekly, right around in here, looking for key support. You could probably make the argument that there deserves to be a level much closer to this 560, noting that we had lows, lows, lows. If you break that, absolutely thinking about the pullback into 555. But if the consolidation is above, right, here is fine. This is technically fine. If we support and maybe Brigade bolt back over the all-time high and Friday's low, that looks pretty good. This is all bullish happening over the 38.2. If we come in here with the anchored view apps from an intraday perspective, notice that we're technically underneath the FOMC Fed rate cut anchored view app here. So maybe earlier in the week, it wouldn't be unreasonable for sort of this to start to emerge and look for that pullback to possibly hold something like 562.50. And notice down here, it'll be there early on in the week. It's likely going to start creeping in the upward direction, but 555.50 is currently super support with the anchored view app from the original breakdown of the balance range back over here. Generally, bullish until proven otherwise is the continued stance I'm taking on the daily, hourly, and even weekly time frame chart until a look above and fail actually happens. Bullish until proven otherwise. Let's move along to the market internals for the NYSE side of things. If you're not familiar with this dashboard, check out the video tutorial in the top right-hand corner. I've got some minor concerns that are happening over here, and it's just simply noting, and I think we described this on the daily with the lack of really firm, strong, bullish-looking closes. I mean, you didn't really have stellar market internals at any point during the week. I'd say that Thursday looked okay. Thursday looked okay in trend higher zone here. Decent little build out of the cumulative, but we only made it to about 2,400. That's half of what's substantial. The volume flows didn't really get up and over 300 million. And yes, we were in trend higher zone all day. But if we look at the participation in terms of what actually matters from the index score, we didn't really breach the upper bound of this green zone here, which is more indicative of a strong trend day on our hands. And we all know that on Thursday, this afternoon pullback really caused the market to close somewhat unchanged. So we're not getting that euphoric style breakout, even at the exchange level here, out of the market internals. Let's jump on over to the market profile and see what else we can learn. I think you're just going to see the exact same indications. We talked about this on Wednesday for the midweek market update, but on the FOMC attempt to make those new all-time highs, the value was basically unchanged from Tuesday. Now, with Thursday's large gap up, of course the value was higher, but relative to the overall profile, it's not like we had a long drawn out profile, which would be more indicative of a trend day. It's much more of a normal distribution, and the point of control is just mildly towards the upper third of the overall range there. And then on Friday, of course, you actually see that value is completely break away to the downside, right? From here to here, it's technically completely underneath, meaning that longs late to the party, if they were trying to transact new business at these highs, they're probably already feeling trapped on the pullback from Friday. That euphoric breakout never really happened. So a key gauge here out of market profile would just be to say something like, if we're underneath the value area low from the Thursday session, which in the ES futures is roughly around 57.6750, if you're underneath that level, you're probably looking at continued consolidation, if not further pullback. And if you were to recapture that level, that's where I'd start to be thinking a little bit more constructively about blue sky continuation and looking for new all-time highs. The level over on the S&P 500 cash ETF that you could use there is something like 570.75. 570.75. If you get back over that, probably a little bit more enticing for a move in the upward direction. Let's jump this over to the QQQ NASDAQ 100 and see what's going on from the weekly perspective. We'll do the same top-down analysis and take a look. So on the weekly, we know that we have some concerns about the possibility of this acting as a lower high zone away from the all-time high. We'll talk about it in just a moment, but let's keep it grounded in our process. Let's remain status quo. What do we see from candle structure and location? Candle structure, I'd say this is a solid green-bodied bar. We don't really have as meaningful of an upper wick here out of the QQQ NASDAQ, and we've got about the same size lower wick. So overall, strong weekly close near the highs of the range. On the bar-to-bar count when it comes to location, certainly a higher low as well as a higher high, with a close completely outside of the previous week's range in the upward direction. It's definitely not a new all-time high close, but generally structure is more bullish along with location. I do like the fact that from here to here, we've got ourselves a higher low, and now at minimum, we're trading back up into these equal highs. If you recall from a number of the previous weekly, watch list videos from the weekend or intra-week on Wednesday for the midweek market update, we said if the S&P 500 was going to go on to make a new all-time high, the bare bones minimum of the NASDAQ would be to at least make some sort of equal high here on the weekly chart, and I'm pleased to sort of announce that, of course, it's done that. And if you've been watching intra-week, you of course know that, but this checks out. I would say that it's okay. The S&P could possibly hold that all-time high pullback and look for continuation. The next major step would be, okay, if the S&P is going to continue to push into blue sky territories and not suggest a look above and fail, you probably just want the QQQ on the weekly to break what could now be considered a little bit of a higher low double bottom over this neckline, probably trades back into the all-time highs here, closer to 500. So the weekly chart looks constructive. I like the close. It's not like we printed an inverted hammer and we're backing away from this level aggressively. You're sort of in range compression, yes, with highs, lower highs, equal highs, lows, higher lows. I think that the break of this level is really going to be the big tell as to whether or not the market will get continuation in the upward direction. Let's take a look at a couple of the additional indications here, starting with the Fibonacci's off of this swing low up to the high. If you were to pull back for another weekly higher low, which wouldn't really be ideal, the level to use would be 462.20. That's coming from your Fibonacci's there. Let's come in with the anchored VWAPs on the weekly. And you'll notice that we're above the entire cluster. Actually, the lower wick of last week's range supports off of that quite nicely. So I'd say you want to continue to remain above that to be constructive on the double bottom breakout. And then finally, we'll come in here with the volume profile on the weekly, see what else we can learn about the activity. Let's drop this thing down to something like a 6-month chart will do. And as we can see, the clearance of these highs really opens the door for a low volume rotation into those all-time highs. So buyers, you know what you've got to do. You've really got to see price acceptance up and over these equal highs, which are very close to the 485 level here on the weekly. Let's drop it now back down to the daily. Let's get a little bit more granular. We'll evaluate this week's expected move, the overall trend. Here's the expected move. If we're contained by the upper bound, the number is at 491.73, and if we're contained by the lower bound, the number is 473.08, implying a higher high for trend continuation and a breakout over that weekly pivot. That's bullish. And if we're contained by the lower bound, it's even above the soft lows here from the earlier stages of last week. So I'm liking what I'm seeing. And even beyond that here on the daily time frame chart, notice that this was a flat top breakout area, and we actually tested above on the FOMC day and closed pretty firmly back underneath. Now, if you watched Wednesday's update, Wednesday's close was fairly concerning. I didn't like the fact that the buyers were unable to really accelerate over that level or find any price acceptance there. I was promptly proven wrong, which I'm somewhat thankful for in the long-term accounts, by Thursday and Friday's activity, then finding acceptance over this flat top breakout. So instead of look above and fail, oh my goodness, let's prepare for a full rotation back down into the equal lows, now we're a little bit more constructive. We've got some key areas to be thinking about here on the QQQ daily. In a picture-perfect world, which we're already seeing based on the lower wick of the Friday session, continued consolidation just happens here over 477, and then we look for that breakout to possibly close the gap overhead. On the daily chart, that's between 488.50 and it closes at 493.10. That would be bullish and certainly continue to allow for progress into blue sky territories out of the S&P 500. If we fall underneath 477, I wouldn't argue that it's the end of the world because we're pulling back from, at least at this point, more of an equal high, if not a very, very slight and nuanced higher high, but the higher low needs to be found, no ifs, ands, or buts about it, over this level here at 468.35. So consolidation that looks like this, I wouldn't really trade for this outcome. I would not try to take shorts under 477 into 468.35, but you would look for that pullback, and ideally buyers would step up here and offer something that looks like this into the future to then resume the bullish overall trend. You would have lows and some semblance of a higher low pulling back from the highest high in the trend count. So that's the progression I see here out of the daily for the buyers, which would subsequently imply that if you're looking to be bearish, you probably want to see price back down underneath 468.35. Some sort of big breakdown, just consolidation, then a lower high. Now we can start to talk about more of an equal low here. And if this does end up continuing to act as a laggard, we'll sort of, take those implications over to the S&P and probably dial back expectations of blue sky breakouts continuing. Let's drop it on down to the hourly time frame chart out of the QQQ NASDAQ. You can see a little bit of the similar story here with the lack of follow through on the Wednesday FOMC. A little bit better here out of the Thursday session, pulling back, unchanged, yes, but completely outside of that Wednesday high. Remember that there was a little bit more of an unfilled gap here versus the S&P closing the gap on the first day. You did get a repair of that structure on Friday, setting up a very similar double bottom here, but right at the inflection point, which I actually like a little bit more so than the S&P. So if you could see out of the NASDAQ early on in the week, let's say an open inside of Friday's range, a Brigade bolt intraday over 483 probably looks like this for bullish outcomes in the upward direction, testing the bottom end of the gap, 488.50, then possibly closing that gap up to 493.10 up there to close the gap to the upside. If you're going to see consolidation, I really would not prefer to participate in this range here. And I also would not really prefer to participate in this range here. It gets a little bit sloppy looking for shorts, honestly, out of the QQQ at this point. I'd say the best short is if the market does end up being bullish and you're looking for a pullback off of the gap fill reversal, that might be a little bit more ideal up there, but that sort of assumes bullish continuation. I think that the short around this zone in here, because of the way that we're holding up over this flat top, I think that it's the wrong area to be getting short in. I really think that for the sellers to build much more of an edge, you probably have to see that failure underneath 468.35. So like detrimental outcomes early in the week might look something like, okay, you get consolidation, you break down in here, and then maybe something like Wednesday, you start offering a lower high for massive expansion well beyond the lower bound of what the weekly expected move is suggesting. Again, it doesn't seem as though this is the top priority for the market right now, but it's something to at least have in your back pocket if you're looking for the sort of like green light to say, okay, shorts are probably more favorable. That's underneath, once again, one final time, 468.35. Let's quickly throw on the anchored view apps intraday for the NASDAQ. You're actually holding above the FOMC anchored view app versus the S&P, which was technically underneath. So once again, the bullish outcome here for the Brigade Bolt up and over 483, I'm not, that's probably a top watch early on in the coming weeks worth of trades. Slowly over time, this, depending on, time of week, might be confluence with 477. If you do get, this wouldn't be an insane take, right? So I should probably throw this in here as a situation as well. If you're getting this pullback and you can clearly see buyers stepping up off of 477, if you could spot the inverted head and shoulders, if you could spot the hourly hammer candle here, it's probably a decent shot at a long as well, looking for risk reward that maybe looks like this, back up towards the bottom end of that gap and possibly ballooning runners into the, 493.10 gap close overhead. So 477, watching that as a key support. That's what we've got out of the anchored view apps. Let's quickly check in on the Fibonacci's off the lows from here to here. 38.2 is just smack in the middle of this balance range, really not liking that as an indication. We could try to come in from like the low of FOMC to the high. I think you're really splitting hairs here. You do get the 61.8 with confluence at the 477, so possibly, if you really want to try to push your luck, you could try the short underneath that level for a rotation here. Personally, I'm just, telling you what I'm going to do. I'm probably going to avoid shorts in this very, clearly choppy range. Even if you look further left, very choppy range back here. I don't think the cleanest opportunities really present themselves inside of this box. Let's take a look at the NASDAQ side of the market internals, see what's going on from this perspective. You can see, once again, pretty lackluster, especially on Friday, even though we closed out as a hammer. I'm not going to say that these are the most bearish internals, not as bearish as it could have been, absolutely, but a little bit more so than the S&P, so sort of torn from that indication there. You will see a substantial volume inflow close out of the Thursday session above trend higher zone on Thursday. So sort of a mixed bag here. I would tend to side more so with the structure, and you can probably hear the hesitation in my voice paired with the market internals now that we're taking a look about really wanting to get active in this range. I don't think that the indications are all that clear in this box. If price can literally prove to us that, yes, buyers have it going on over 483, I'll entertain that trade even with the way that the internals looked on that Friday hammer candle. Let's take a look at the market profile for the NASDAQ side of the market here. Let's get a couple of these sessions on the screen. So you can see pretty much the same indication with value here on Thursday. Here is value on Friday. Notice that it is completely breakaway to the downside, just like the S&P, but we do have a poor high here out of the NASDAQ, which the S&P did not have. So this represents really the improper end of the auction, meaning that if that's going to be repaired, we should expect any tests of Friday's high to yield a breakout, which aligns beautifully with what we were just describing anyhow on the hourly chart. Any tests and breaks above that hold above, probably looking for Thursday's high to possibly act as a target. So liking the poor high confluence that we're seeing for that thesis here out of the market profile, which FYI, I know I didn't point it out on the ES, but if you're not familiar with the market profile, check out the video tutorial in the top right-hand corner on what all of this means. Let's finish up the big three indexes with the IWM Russell 2000 here. Let's go out to a weekly chart as we typically do in these Saturday videos. Let's jump up to a weekly. We'll throw on the clean drawing set. Thanks for bearing with me. We can even remove those drawings, make it really clean. And what do we see? Candle structure, location, everything that we typically look at. So candle structure is much more on par with what we saw out of the S&P 500, a little bit more of a meaningful upper wick versus what we just saw out of the NASDAQ. But honestly, the structure overall here, trading near this pivot high instead of up near all-time highs, is more similar to the NASDAQ. So interesting little divergence happening there. Notably, I think that the opportunity for a sustained higher low needs to be held over this 210. We'll see it on the daily chart as 215, the bottom end of this balance range back here. But I like the recovery. If I'm being honest, I like the recovery here. I like the range compression we have. Like if you're counting from way back at the origin, right? Lows, higher lows, grinding higher lows in the upward direction. This is technically a higher low. We've gone on to print a big higher high here on the first euphoric break of that move. And yes, this is technically a lower high, but now at least you have an equal high. And it seems more possible that an equal high could be found here, which then subsequently would imply any movement over that would unlock the next phase of the trend sequence, which means any higher lows could be found, so on and so forth into the future progression. So the weekly chart really isn't all that bad. I like the fact, if you really just want to keep it simple, if you use a box here, right, we're trading in the upper third, and we know that we have these divisions on the daily. As long as we trade in this upper third, more bullish than bearish for the S&P 500. Ideally, something like this happens. I'll certainly change my tone when and if we trade into this lower bound down over here. We're just simply not there yet, and the weekly structure is not really suggestive that we'll be down there anytime soon. As of right now, the small concern is the upper wick looking above and failing to close above this prior pivot high, but on the daily chart, we'll see that really the rally is just fine. Let's come in here first with the anchored view apps out of small caps. This cluster underneath us can act as support still, and if we bring out the Fibonacci's just on the entirety of the range from the bottom up to the top, we are over the 38.2, so ideally, last week's low holds as bullish consolidation, and we'll look for follow-through over time. While we're still on weeklies, let me just go ahead and remove the study sets here. I do want to check in on KRE regionals, these still look fine, noting that the consolidation is holding up over the 53 mark, which was pretty ideal. And again, breakouts over these equal highs probably put the pressure on in the upward direction, more so for the S&P. Small caps, things start to improve if you could break out through this flat top here, closer to, let's say, 59.35, give or take. So that's KRE. We could also check in on something like XBI to see what's going on in biotech. Nice flat top brewing over here, looking for a possible continuation move into the prior swing low. And let's try XRT as well. With retail sales coming in sort of at expectations, no major concerns, right? We sort of are just inside of this consolidation range. Concerns would really emerge out of these more esoteric watches when and if we were to break on down and make new lower lows. We're simply not there yet. The consolidation persists onward. Let's drop it back down to an IWM daily time frame chart here and see what's going on out of small caps from this perspective. So FOMC, and sort of mirroring the take out of the S&P and even the NASDAQ, really leaves us with a very weak close on that Wednesday session. Thursday's gap up is important, or I should say open back in range, but towards the upper third of that range is important because it gets us over this daily pivot high right here, and it actually acted as support on that Thursday session. Friday's breakdown and close underneath, a little bit of a concern, meaning that if we were to test these lows because they're so precise, I would expect that you honestly go through that, and then it becomes all about the line in the sand here at 215. We ideally want to see price remain in this upper bound, which is what we were just talking about on the weekly, to remain bullish and once again carry that pressure over to the S&P 500. So 215 is the top watch here out of the daily, and this breakdown here on Friday honestly doesn't sit all that well with me. The reversal from the Wednesday session really doesn't look all that great intraday. We'll look at the hourly in just a second, but I do just want to point out that your weekly expected move here is suggesting maybe a very nuanced higher high over the FOMC high at 226.27, and the lower bound is technically over our line in the sand at 215 at 216.93. So use that as you walk forward. Let's take a look at the hourly chart and once again point out some of this lackluster activity. Here is the Wednesday FOMC breakout over the previous high. Technically, you hold this high on Thursday, but Friday is really just chopping around that 222.15. So I don't think it's fully resolved. I would tend to think, again, any acceptance under 222.15 early in the week probably means that you're at least testing this, which is a very mechanical and very weak low at 218.35. It's the back-to-back daily lows of Tuesday and the Wednesday FOMC, right? We just talked about how if that gets tested, we're probably looking for a breakdown. Why am I bothering talking about all of this possibility of a breakdown out of small caps? Because it probably aligns with some sort of sustained consolidation or maybe a mild pullback in the S&P 500 itself. Let's jump on into the anchored VWAP indications intraday. You're underneath the anchored VWAP from the FOMC move. This is confluence here. I would really be expecting this to break, honestly, at 218.35. The most bullish thing that could happen there, and mark my words, if this happens, you might hear from me about it, but if we break through it and then quickly wick back above with a higher low for something that looks like this, I think you've basically just seen a very quick stop run underneath this level. If this situation right here ends up playing out, I would be bullish in small caps and probably looking for that to be a bullish outcome in the S&P. If this is a very snappy break, collect the stops, run the stops, whatever you want to say, market maker voodoo, right? Whatever. If you get the higher low right back above that level, bullish for the S&P. Intraday, I will be looking for longs in the ES, right? So carry that forward as a possible idea if we test 218.35 out of the IWM. Let's quickly come in here with the Fibonacci's off of the low of this move up to the tippity top. You can see the 38.2 is loosely mixed in here near that 218.35. So what would maybe a picture perfect situation be? Breakdown, sweep it, support the 38.2 back above the anchored VWAP, and a higher low Brigade bolt here, 218.35 off to the races. Once again, bullish in the S&P 500. Just a possible idea, very, very speculative. I'm not holding my breath for that particular outcome, just talking about how you could potentially trade that chart. If you are getting bullish consolidation, let's flip the script here a little bit, Matt. What if we actually just get consolidation up here? Absolutely bullish for the S&P 500. I would look for the NASDAQ to then be the gatekeeper for the S&P. This is sort of saying like, okay, you have permission S&P. NASDAQ would be the final shoe to drop if the NASDAQ breaks out and gives us that bullish Brigade bolt to possibly close the gap overhead. That's where, once again, you could probably leverage more so longs in the S&P versus shorts. So liking what I'm seeing under these circumstances, if the NASDAQ also wants to play nicely, looking for something that does this in the IWM. Let's quickly check in on the RTY through the lens of the internals. You can see actually some decent volume outflows into the close of that Friday session. Very odd and very unlike the index to sort of open so low away from the zero line there on Friday. That's kind of noteworthy, as a matter of fact. You did get a pretty bearish advanced decline line here, not in trend lower zone, but not great, and a bearish cumulative build as well. Once again, I think that this area is susceptible to a breakdown, and then it becomes all about that stop run and whether or not we can support off of that. So I think the bearish bent that I sort of had on the daily and hourly charts was correct based on the internals here, but it's really a matter of watching to see whether or not those areas start to act as support on that sweep. Let's take a look at the market profile for the RTY. Again, the difference here is that on Thursday, Friday, just on a relative basis compared to the S&P and the NASDAQ, is just that you never got acceptance outside of Wednesday's high. It's just completely inside. Notice that on Friday, the point of control actually shifts dramatically lower in the overall profile, and this is completely disjointed and underneath the Thursday value. So again, I think that the bearish stance here is slightly more correct into the early stage of the week, looking for the equal low breakdown, and then of course here is your mechanical low out of the Russell futures. You can see that even on the Wednesday session itself, it's not just mechanical because it's equal to Tuesday, but there was actually a poor low left in the wake of FOMC, E and F periods there at 22, basically 20 in the Russell futures. Let's jump back on over to the platform and let's dive into our sector analysis. Let's keep the show on the road. What do we see here out of the weekly performance of the S&P sectors? Who was leading, who was losing, and where was the weight? I feel like it's been a while since I've said that one. Energy leads the pack, up 2.84%, followed by XLY consumer discretionary, 2.24%, then financials up 2.15%. Energy is pretty lightweight, but beyond that, discretionary and financials are definitely more of a risk-on indication as this market's attempting to make new all-time highs. If we look at the bottom end of the barrel, it's the real estate sector, it's the consumer staples, and it's healthcare, all of which we know are either lightweight or technically D for defensive. So the posture here strikes me as fine. Also note that as the S&P is breaking into blue sky territory, the TLT is not outperforming by any stretch of the imagination. So is there a flight to safety without even looking at the ratio chart? Absolutely not. Let's check in on the structure, though, and see what's going on here. So energy, I like the rebound off of these lows, but I still think that there's an opportunity for a possible lower high to be set. Let's check in on crude real quick and see what's going on with CL. Yeah, crude is not yet able to get over this sort of flat bottom from in the past, and I would tend to think that lower highs being set here continue to pressure the XLE. Remember that this probably falls more into the category or theme of recession if global demand for crude starts to slow down here underneath these lows. So I'll continue to watch this as an indication. I wouldn't say, oh my goodness, short the market because crude is suggesting this pattern, but it's one data point to have in your back pocket. Let's move along to discretionary. Huge new highs over here, not new all-time highs. Those are way up here at 215, but certainly good progress in the upward direction. I like the fact that this is getting up and over the previous swing high over here. I like the fact that even though on Friday we looked underneath Thursday's low, we closed back inside of Thursday's range. So is there plenty of opportunity for a higher low pullback here and continuation? Absolutely. Is there plenty of opportunity for this? On the weekly perspective, absolutely. Hard to be bearish here out of the XLY. Financials look great, pressed right into the all-time highs after a beautiful hold of this 44. Never a daily close back down underneath. Multiple inside bars here into the end of the week. Maybe not completely inside with Thursday technically looking above the Wednesday high, but regardless, this consolidation looks awesome. I'll be monitoring very closely for something like this to be bullish pressure in the S&P 500. If it does pull back, we know that it's technically okay to still spot a higher low above 44. Now, not just like a daily close that remains above, but the low of day at this point needs to be above 44. Next up, we've got communications, a breakout into blue sky territory with the opportunity for a higher low Brigade bolt above. Very difficult to say anything bearish about this. Looks more bullish than bearish once again, like we talked about in the S&P intro on the weekly. If it does end up emerging as a look above and fail, we'll take that in stride when and if it happens. I don't think we want to use that as a primary outcome. I think for now, the consolidation is bullish until proven otherwise. That's sort of the tone of the video as we've been seeing so far. Semiconductors have finally broken back out over that 237 level, which we know is oh so important from this mild consolidation here, the origin of the breakdown. It was a flat high resistance point for a number of days in a row. I like the fact that on Friday you looked underneath the level and then closed back above. It's really important that semiconductors early on in the week continue to find price acceptance above 237 and possibly attempt the rotation into this equal high closer to 255.70. That would be bullish for the S&P 500. Here it is on the hourly time frame chart, just because I want to show you the close back above was sort of this late day rally, if you will, out of semis. So early on in the week, so like Monday, Monday, Tuesday, you probably want to see very prompt price acceptance above and not really testing underneath anymore. If you do, it starts to suggest what, right? Of course, from a pattern perspective, left shoulder, head, right shoulder. If you're back down underneath, things get dangerous underneath 228.50. Again, we're not there yet, but I'm just showing you where we would have to change our mind about the bullish stance we've taken so far in the market. Next up, we've got the tech sector. What's going on with the XLK? Interestingly enough, out of the XLK, you're not seeing an equal high from the weekly perspective. Now, I'm not going to sit here and argue that it's bearish. I do like the recovery of this 218 level, but it's not quite as strong as the QQQ, honestly. So I'd like to see further consolidation really go for at least the equal high, if not the gap close. If we're going to maintain that bullish stance in the S&P, I mean, maybe the hammer from Friday is enough to do it, but let's make some new highs. Let's make some equal highs here. This has to happen sooner rather than later. If this really just struggles in here, and then heck, for the sake of continuing with the same pattern, if this really emerges as a head and shoulders on the hourly underneath 218, I think you're really dealing with a trickier outcome in the S&P 500. So wanting to see this play catch up sooner rather than later. Utilities, the most bond-like sector, new all-time highs on Friday. It is D for defensive. It's also lightweight. We just want to make sure that the other sectors are playing nicely in the upward direction if we're continuing to press the gas on the S&P into blue skies. If they're not, if we start seeing pain in the XLK, if we start seeing pain in semiconductors and discretionary, and utilities continue rallying here like a balloon floating away and the S&P is holding up near highs, that would be an indication as a red flag. We're not there yet. Next up, industrials, new all-time highs, plenty of opportunity for a higher low pullback over the previous all-time high. Nothing bearish to say about that. Next up, materials, finally breaking out of this long-standing balance range here. Ideally, this holds as support. I would say that my largest concern for materials is not even just like a look above and fail. If it just continues to chop in the range, whatever, so be it. It's a really lightweight sector. I'd be concerned about materials when and if there's a large panic break underneath 86.25. As of right now, doesn't even look remotely close to being a primary outcome for the coming week. TLT has pulled back aggressively off of this high, and again, we know that the market had priced in interest rate cuts, and people in bonds are possibly taking some profit up here, causing the sell side pressure. It's fine, doesn't really strike me as a huge concern. Real estate, same concept. This is the pricing in of interest rate cuts. The rate cuts happen. Everybody's like, why are bonds pulling back? Why are rates going higher? Because it was priced in, and there's profit taking basically. And again, lightweight sector out of real estate. It's not going to move the needle. Next up, XLP, D for defensive, hanging out near these lows, not pressed into highs. So that strikes me as okay. Ideally, this just continues to consolidate here as we get the catch-up play out of the XLK and SMH. If this really aggressively takes off, it will be upward pressure for the S&P, but we don't want it leading the charge if we're making new all-time highs without the help of the technology and semiconductors. Let's take a look at XLV last but not least. D for defensive, but third heaviest weight sector by market cap. So continued consolidation here is bullish for the S&P. As long as this is not breaking down more aggressively underneath 150, 150, I'm all set out of healthcare. Let's jump on into the ratio grids and see what's going on from this perspective. If you're not familiar with how to set this grid up, check out the video tutorial in the top right-hand corner. Still some red flags. So the sector structural charts themselves look fine, I would say. There's really nothing there that's like, oh my goodness, buckle up for a huge market crash. But if we're thinking about the overall ratio grid, this still does not give me a warm and fuzzy feeling inside with the underperformance from the XLK. I mean, you've really just produced this equal high into the end of the week. Ideally, you make it into this as an equal high and you prevent a lower high sustaining itself underneath the downward sloping 50 SMA. So this will be a top watch this week. Financials starting to curl here above the upward sloping 50 SMA. That's bullish, probably in unison with the XLY looking good, with the XLF looking good. It's probably enough to outweigh the lack of progress here out of the XLK, but probably can't persist for much longer. If this reverses, you're not really left with much if the XLK is not performing well. Defensive healthcare is coming underneath the 50 SMA, which strikes me as fine. I like the fact that defensive staples are coming underneath the upward sloping 50 SMA. Utilities, not so much. Still a little bit more risk off indication coming from that one. So overall posture, it's okay, but it's not as good as it could possibly be to give us bulletproof confidence near the all-time highs. Let's jump into the risk on versus off grid. You're seeing some big improvements out of this over the 2.6, but again, ideally it would have made more of an equal high. We're still somewhat underneath. If you look at XLU, again, no surprises there with the new all-time high. So still not quite all the way to risk on. This is the best looking chart, honestly, which is apples to apples, discretionary versus consumer staples. I like the fact that it's up towards the top end of the balance. I like the fact that it just sliced right through the 50 SMA. And you could sort of think about it like this. if the market was really concerned about a big recession and, oh my goodness, who's going to be able to spend on discretionary items? It's all about staples, right? Growth versus value, basically. This chart would not look like this. If there were larger concerns about recession, this probably would be drilling to make a new lower low. It's just not the case right now. If you look at semiconductors versus healthcare, it's trying. I like the fact that this is possibly a higher high, but you still have this threat and you're right at the 50 SMA. It needs some improvement there. The Japanese yen carry trade is still not really on the table. And if you take a look at the Nikkei, let's go here real quick to 25. I always get that one wrong. There we go. You're starting to rotate back in the upward direction. So any concerns over here? Not really. Pushing back in the upward direction. Let's talk about the dollar real quick. And we can see continued weak consolidation on the lows, which is actually more supportive of the market making this move in the upward direction. And it shouldn't really be much of a shocker that gold, of course, is pulled back. Oh, sorry. I guess I have not checked in on gold into the end of last week as closely as I should have. Okay, gold might be sending a warning. Gold might be sending a very subtle and small warning here. Again, this is not to sound the alarm. This is not to say S&Ps are going to zero. But gold shouldn't really be breaking out like this if it was all good in equities down below. This certainly looks a little bit more D for defensive. Now, could it just be a technical break in the upward direction, clearing these highs after a strong established base? Pullback, break, higher low pullback. There it is for continuation. It's possible, especially noting that the dollar hadn't really, if we just quickly flip back to the dollar, if we're thinking about how this is expressed as currencies, you didn't really see like a very aggressive breakdown out of the dollar here. So I'm not convinced that maybe gold's breakout there is the most defensive thing I've ever seen. It looks to be a little bit more technical based on what I can see between these two relationships. So there's some real-time analysis for you. Let's jump into the TNX and see what's going on with interest rates. We know that these are ticking in the upward direction, but for the huge opportunity of a massive weekly lower high, of course, moving in the upward direction because of the profit taking in bonds doesn't strike me as a big shocker. If we take a look at the inverted ZT, which is just the 2-year, you can see we're a little bit more stable down here towards the lows. Let's jump into the Fed tracker tool and see what's going on from that perspective. We'll talk fundamentals for just a brief moment. You can see over here that the market is starting to price in another 50 basis point cut for the month of November, which honestly I think will continue to be a huge policy misstep. In the intro, I said I'll show you where I have a very specific concern about this whole recessionary theme. I actually think that stagflation is going to become more of a threat versus anything else. So a lack of growth paired with inflation resuming. And again, this is a little bit more of a personally held belief. I think that the data supports this belief, but take it with maybe a grain of salt. I think that the 50 basis point rate cut was too much in response to a problem that we do not have. And that problem that we do not have is massive deterioration in the labor market, right? And if we look at the report from what happened last Thursday, you can see that continuing claims and initial claims both saw a substantial tick in the downward direction. Is the market going to basically get the rate cut on Wednesday and see this data improve by Thursday? The answer is absolutely not. So don't come knocking on my door saying, "Oh, look, the rate cut saved the jobs market." Absolutely not. This was happening prior to. This was the market pricing in that a 50 basis point rate cut was going to happen. And okay, maybe things eased up a little bit without the deterioration continuing. So I don't think that the Fed could have gotten everybody all on edge about a 50 basis point cut, issued 25. The market does their job by pricing in the 50. And now, okay, maybe we retrace a little bit. But in the SEP, they could have signaled, okay, maybe we'll reduce the end of year rate a little bit more aggressively. There's a number of ways they could have dealt with that. But again, I see that this lack of deterioration in the labor market is kind of not really supportive of the 50 basis point cut. Again, I could be a little bit too personally sort of reading into this. I'm not going to claim to be the world's best economist, but from what I can tell, it seems as though, and this will be really telling in the subsequent month of October when we get the updated CPI report. This is this week's calendar. But does inflation come roaring back becomes the next key question. If the data out of inflation actually deteriorates, I think we're going to have trouble on our hands, and the market's going to sniff it out as soon as that CPI report comes out. So here's what we get next week. I'll be paying attention to GDP on Thursday at 8:30. Of course, continuing to monitor the labor market at 8:30 as well, initial and continuing jobless claims, and Powell looks like he's on the mic on 9:20 on Thursday morning, September 26th. So prior to the market open, we'll see if we can get his volatility out of the way, and we have the day to remain trading with normal activity. 8:30 on Friday, core PCE, probably a nothing burger as everybody just awaits the CPI print for next month. If we look forward, Here we go. It's going to be jobs first to kick off the month. You can see jobs here, Friday, October 4th. That'll be pretty telling. Again, the Fed should have maybe some commentary. The market's going to respond based on the Fed's anticipated commentary. And here's the CPI, October 10th. I think this is going to mark the next big moment. You know, if we're just sort of talking and spouting off about fundamentals right now, I think October 10th is your next big tell point. I really don't think that the labor market's going to get out of hand next Friday, the Friday prior to that. Friday after that. I'm getting all over the place with these dates here as we're looking at the calendar in real time. But this, I don't think, is going to send the market over the edge. I think based on the data we've been receiving, the unemployment rate's going to be fine. It's not going to get out of control here. I think that the ADP non-farm might slow down a little bit further. But again, CPI, I think the stagflation fears really ripple. More people can resonate with the stagflation fears versus the, oh my goodness, the labor market's blowing up. Enough about that. Let's start talking a little bit more about the earnings calendar. There's not much going on here. Micron, I would say, is going to be the top watch this upcoming week, Wednesday after the close, to possibly give us the next direction out of semiconductors. We were talking about the SMH, not really making a clear decision around that 237. Micron could be what it takes to either send it higher, much firmly above, or lower, much firmly below. Costco after the close on Thursday might be interesting here, but if we just think back to what happened last week, FedEx reported earnings, and FedEx typically has a pretty good pulse on the state of the economy, and what they said wasn't all that great, right? So this maybe does support more of the 50 basis point cut, but right here highlighted, weaker industrial economy is what I want you to focus on, and I want to think about this for a second with you in real time. Industrial production is certainly important, but what really is the top market cap of the economy right now? It's certainly obviously technology. So I'm not saying that this is not an important segment of the economy, but with the emphasis on tech, I really think it's about like Micron earnings and, you know, whether or not inflation is going to get back out of control and consumer spend is going to take a hit. So I do respect what FedEx has to say about the economy, but I'm not really as concerned about the industrial side. That might sound a little bit selfish, and of course, if you have a job in the industrial sector, like I'm not trying to be poo-poo on the industrial side, but generally, if we're thinking about market-related outcomes, I don't know. It's not as bad as maybe the 2021 announcement that they made that sort of forecast what happened in 2022, where we know that the market really went through a more severe downturn. So let's jump on over to the FedEx chart just so I can sort of show you that really quickly, and then we'll continue along with our analysis. Here's FedEx, and we want a daily, but we want to zoom out. Let's go out to a 4-year chart, should do. This is where they first started saying, hey, things are slowing down on this earnings report. This is 2022 when we had the massive drawdown, right? Obviously, look at this earnings report back here. So this is what we have currently. I'm not saying it has to be the same outcome. It's worth taking with a little bit more weight than maybe just some random company that reports earnings, but that's what we're currently dealing with out of FDX. Once again, you've heard my thoughts about technology versus industrials, and even let's take a look at let's go $DJIA for the Dow Jones Industrial Average. Can we just hit enter there and get it? Yeah, this is fine. So, I mean, look at this big breakout out of the Dow Jones Industrial Average. If people were really concerned about the literally industrial side of the economy, would this be breaking out to new highs? Probably not. Right? Let's go ahead and take a look, because I don't know if the DJI AFR is exactly what we want, but let's just go to the diamonds, which is DIA, as a S&P product here, right? It's a similar looking chart, so I'm sure it's, you know, almost the same indication, but big move in the upward direction. Once again, if people had more concerns about the industrial side of the economy, if the numbers weren't looking great, would the diamonds be trading up here at new highs? I don't think so, right? Absolutely not. So with that, we'll get into the risk on versus off indications, the sentiment and all that stuff. Here we go, TLT ratio to the S&P, big time low or high. I'm really watching for the breakdown through the equal low. That would signal more of a risk on indication for S&P equities listed down below. Let's take a look at bonds relative to themselves. Small upticks here, but once again, we've been saying this over and over. It's a uptick in the context of an existing downtrend, not a concern from a duration perspective. What about the HYG credit spreads and the LQD credit spreads? If market participants, let's phrase the question like this as we go through these indications, right? If everybody was concerned about a recession that's impending, you would think that credit spreads would widen. You would think that there'd be much more of a preference for government-backed safety, not company-backed or junk bonds even, that are highly risky, right? But these things are contracting big time. This certainly would not align with the idea that a huge recession is looming and everybody's starting to price it in. What if we take a look at the HYG in isolation? Here we have it, new highs into the end of the week. What about the LQD? Just to stay consistent and even take a look at corporate grade. A little bit of a pullback here. You might read into that just a little bit and say that this consolidation and then go might make some more sense. But again, if you're thinking through the framework of do market participants fear a big, dark, dirty recession, this does not look like it. I mean, if that was the case, this should be in a downtrend. It should be making new swing lows. Not the case right now out of the LQD or the HYG. Let's jump into Bitcoin. Nice little move in the upward direction here, back inside of its balance range. That's a slightly more risk-on indication for markets. Let's look at total breadth, seeing an uptick last week out of the moving average charts, but a minor downtick out of new highs versus lows. Generally, as long as this is away from the zero line and certainly not threatening negative, we're all set. I'm not really concerned with new highs versus lows. Minor pullback is A-okay. What about the RSP, just basically as the one sort of gauge of them all? Certainly higher low over the prior swing high, very similar now to the structure out of the S&P weighted. I think that this is fine. So from a breadth perspective, all set. Once again, not really suggestive of, oh my goodness, recession is impending. What about the equal weight NASDAQ? Any differences here as we come into the equal swing high? The answer is no, which is a good thing. This is a good thing, right? The fact that this is right here at the swing high and not suggesting some sort of lower high. So all set out of the NASDAQ, looking a bit more constructive there. Industrials versus transports. Transports are saying, whoa, hold your horses on Friday. Look at that massive breakdown. Not entirely sure what's driving that. No pun intended. Terrible dad joke, I know. Anyways, industrial still hanging out near the highs. Once again, I think based on our previous conversation, there's not much bearish to say there. You might be somewhat skeptical, but this is not making new swing lows out of transports. Let's jump into volatility and see what's going on from that perspective. Underneath 15 would be comfortable this upcoming week. I think with the Fed in the rearview mirror, that can start to unfold, especially if we go into like all-time high grind mode. You're probably looking at a VIX underneath 15, so be on the lookout for that. If it remains elevated, obviously, it would sort of signal that market participants are maybe a little bit more concerned about the pullback. Can you tell that I had a double shot latte before filming the video today? Feeling caffeinated, stumbling over my words, the brain's moving at 1,000,000 miles an hour and the lips are not. We've got the VVIX coming down underneath 103. Again, fine. If this can move back down to comfort zone, probably more suggestive of that all-time high grind, and you probably just want to look for that to happen in confluence with the VIX under 15. Let's jump into the the volatility futures rather. Small backwardation here, but the contracts just expired. Don't forget that we had a quad witching, triple witching, whatever you want to call it, on Friday of last week. You can see this is moving into a deeper contango as well. So I really don't see an issue out of volatility. It seems more so that the market has gotten the Fed out of its system and it's more likely to start settling down volatility-wise instead of expanding. I think the next major volatility event is going to be, as we've already noted, the October, 10th maybe? October 20-something, the CPI report, right? Don't quote me on the date. You can go back and find it. But generally, that's where I think volatility will resume. One-day VIX back down underneath 1275, which is the comfort zone down here. Let's jump through the core list of companies and see what's going on from this perspective. I'm just going to reset our chart here. There we are. Apple is up first on the chopping block. A little end-of-day drama out of Apple. So prior in the session, it was looking good. Nice little grind towards this not all-time high, but rather the pivot high in here. End of day really got nasty to the downside there, closing weak at this inflection point. So just like this kind of turned into a look above and fail. That one was very aggressive. I'm open-minded to not necessarily the same exact trade down to these equal lows, but possibly a gap close, then looking for support in here around the daily 50 SMA. So on the hourly chart, how might we actually exploit that idea? You can see here that we have very thin structure underneath that 227.75 into the gap close at 222.75 and the 50 SMA we were just describing. You can see that overhead supply was left on Friday midday with the close week into the afternoon. So any consolidation here keeps the bearish pressure on. If you want to assign a pattern to it, fine. There's your head and shoulders. Under the neckline, there's your thin structure. So a couple of ways to get involved. Break, you could take that break because we have the thin structure, or you could wait for the lower high underneath the level, looking to execute something from point A to point B, hopeful that the gap closes to point C. When we get to point C, I would probably put the thinking cap on and say, okay, do we spot double bottoms, inverted head and shoulders, and some sort of gap fill reversal off of that area for a daily high or low? One step at a time, but right now the chart does look a little bit more bearish with this breakdown into Friday afternoon. If we're in this consolidation, I wouldn't do much. I think that the next bullish trade is the all-time high grind once we're over 233. Next up, Microsoft. Really choppy chart. Again, you could sort of take away some of the similar indications we were talking about out of the S&P 500. Sure, percent gain-wise, you're up on the week, but look at all these daily bars. Literally everything after Monday is a red close, even though there were some gap up in here. There's a little bit of a gap down, gap up, right? So technically, you've made some progress in the upward direction, but buyers seem to be somewhat exhausted up here. I'd love for this to turn into a flag on the daily and do something like this into the future, or if it breaks down below this low at 432.15, very open-minded to trading this short, because on the hourly chart, we can all see you'd have overhead supply, break lower high. You've got sort of a thin structure breakout over here. This would be the next major test for a daily higher low. So if you're like, I don't really feel like taking the short, that seems a little bit too counter trend for me, under 432.15 into 425.25, then fine, but just be patient through this drawdown and probably look for more of a higher low opportunity. Look for buyers to step up on the retest of 425.25. So that's my take out of Microsoft, either looking for the flag to resolve to the upside out of the daily, or on pullbacks, primarily focused on this as support, mainly coming from the massive weekly or even daily double bottom, whatever you want to call it, off the neckline. Once again, 425.25. Did I say that enough times? Probably. Here's NVIDIA, our daily time frame chart. Lackluster. Choppy, not really doing much. The SMH is trying to resolve 237 in the upward direction. NVIDIA, not so sure inside of this range over here. So let's take it down to the hourly, because I think it's more insightful to look at it through this perspective. The issue I have with NVIDIA is that on the Thursday session, you opened underneath 118, which technically just puts you in the midpoint of a 4-day balance range here. You recovered over 118, and ideally this should have been what buyers were looking for. You actually did sort of support off of it into the afternoon on Thursday. Friday says absolutely not, gap fill reversal, weak, and then consolidation on the lows. So I'm somewhat concerned that if you were to get some sort of lower high in here, the bears take back control after what appeared to be a constructive step in the right direction on Thursday. The short is absolutely available from point A to point B, noting that what goes straight down goes straight up and probably comes straight back down as well. It's a thin structure retracement into 109.50. When we get to point B, certainly putting the thinking cap on and saying, can we spot the opportunity for a daily higher low? Do buyers step up off of that level? If it's going to be bullish, I really don't want to get involved inside of this range. You can see how, obviously choppy it's been, up, down, whatever. I just want to see this clearance of 120.50, then we'll start trading NVIDIA in the bullish direction. As of right now, it's got some work to do to really prove it. Next up, we've got GOOGL. Let's talk about a recovery effort here with the massive gap up on Thursday and then just sort of consolidating inside on Friday. You've fully retraced the, excuse me, my apologies, from the bottom to the top of that range after a big breakdown here. There was no lower high for trend continuation. So I think that Google inside of this range, let me be the first one to admit that unless you've been swing trading this, it's absolutely brutal intraday. There's really, here it is on the hourly chart, right? So, hey, you get this nice push off the open, nothing into the afternoon, nothing the following day. Gap up, maybe there's something to do, nothing, right? So very brutal to trade intraday. It's really been for the swing traders here out of Google. So as we continue to walk forward, ideally, consolidation would continue here, some sort of Brigade bolt back over 164.75, targets 169. A pullback is very reasonable. I would say that daily buyers probably want to be found here off of 156.50, and maybe even at that point you start to consider that the pattern's inverted head and shoulders spread out over a long number of weeks, right? So that's the opportunity here on pullbacks. I don't know. It's been a little elusive here intraday out of Google, so I'm literally taking it one day at a time. Consolidation, maybe we entertain this. We'll try it. If it continues to just give us this consolidation choppy days, maybe we just put it on the back burner until it starts playing nicely again. Next up, Amazon. Amazon really disappointed that it couldn't just wait until the Monday session, but here it is on the daily. Just want to start on the daily so we can all see we have rejection, 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 and there's free air all the way up towards 195.75. If you take a look at the hourly chart now with that context, I was loving this little building block that was stepping up here. I love the fact that you had a quick look below and fail, starting to get that Brigade bolt over 189.25. But the end of the final trading hour on a Friday session, you decide to break out up and over these highs. So yeah, I'm maybe a little bit salty about the move happening after the fact here, but I'd like to see this continuation play in the upward direction into 195.75. If this can sustain sort of inverted head and shoulders look, if we can get the Brigade bolt here early on in the week, if there's just a momentum play that we can sort of participate in a flag breakout to that level, I like the daily structure and clearing this massive area of resistance here at 189.25. So Amazon will likely be a top watch this week for that reason. Next up, Metaverse. What's going on over here? A little lackluster now near the all-time highs. It's been a pretty impressive breakout to those all-time highs, actually trending cleanly on that Thursday session. Beautiful consolidation, trying to get the Brigade bolt into the Friday afternoon. Over 561, it's blue sky territories. I would not be short under 561 in between 556.25. The short, of course, is underneath for a thin structure retracement, in which case on the daily, you're looking for daily higher lows, daily buyers to step up at the previous all-time high, 542.50. Here it is on that time frame, right? This would be a daily Brigade bolt, something that looks like this for trend continuation. Next up is Tesla. Thank goodness it's answered our prayers here, up and over this into the gap. Beautiful trade on that Thursday session. So for now, I think it's sort of back into setup mode. We're waiting for that next setup to really brew here. I would tend to think that daily Brigade bolt is also on the table. It was an inside bar on Friday, so not really getting a clean indication, but your next watch would be over the two equal highs for something that does this into the swing highs, or if it fails back down under 234.15, now we start to think about, okay, look above and fail. Maybe that aligns as sort of like an regular head and shoulders through the neckline. Now you're talking about equal lows down here. So one step at a time, but for now with the inside bar on Friday, I would tend to be more partial to pullbacks trying to find buyers at 234.15 and honestly trying to rinse and repeat the trade from Thursday. Nice move here. I think that now that you've got the break, the hold above becomes critical. You'll look for the same target, equal highs, if not the full gap close, and possible continuation into that 256.25. The bears only have it going on if there's a move underneath and a lower high set underneath. You need both of those outcomes here. You can't just short the breakdown, or at least I'll tell you what, I'm not willing to short the breakdown there. I would want to see the lower high underneath to firmly suggest that the trend has shifted and the sellers are taking back control. Let's move on over to JP Morgan and see what's going on over here. Daily chart first to set up the context that financials, as they're sitting as a sector near those all-time highs, JP Morgan is not. It's technically underneath its Armageddon bar, for lack of a better term, when Jamie Dimon came out and absolutely crushed the stock along with his VPs. So now that you can see we're underneath that level on the daily, right, this lower high attempt becomes the threat, and that becomes concerning out of this particular name. You'll notice that we have an inside bar on Friday with three equal highs flat across the top, meaning that the counter trend move here, counter to this downdraft, can continue over to 1150. If you take a look at the hourly time frame chart, it's actually a very constructive stair-stepping move in the upward direction. But maybe similarly to Google, I'm not really convinced that these are the best tradable outcomes out of JP Morgan. It's like we make a move in the upward direction, then do nothing for a while. Maybe a small move in the upward direction and do nothing for a little while. So I wouldn't jump into this, expecting a huge long, but maybe there's an attempt for that first move. If we open in range, the Brigade bolt over to 1150 maybe gets you going towards that possible lower high area. I would change my stance and start looking for that daily lower high when and if we approach 215.75. If it's going to be a short on the hourly time frame chart, and if we're going to start to indicate the reversal without getting here, you probably just want to see like the opposite. Just a constructive block being built underneath the lows of the previous block. And that level here would be at 209.50. Next up, we've got Netflix, which just can't seem to get in gear up and over the flag highs on the daily, right? Here's your bull flag, which is broken out. I like the support. I like the fact that these are maybe higher lows, but no acceleration on Thursday when, really a number of other tech components were really getting in gear in the upward direction. So that really brings us to the hourly, where you can see that the chart's been sloppy. If you could get clearance, like a very clear, I don't want to have to pull teeth out of Netflix. I want it to be a very clear indication that there's momentum off of the open or something like that, and a clear higher low over 707.65 is the level I would use based on the more aggressive breakdown from the Wednesday session. This is not just FOMC, that is actually the opening print of the Wednesday session. So 707.65, clean higher low, maybe will participate. Anything in here, I think in the grand scheme of things, it's probably just going to be more so reserved for the swing traders to say, okay, maybe worth entertaining positions in here, stops, and much higher targets into blue sky territories. But as day traders, not really the cleanest action up here. Next up, AMD. Talk about clean. I'm liking what I'm seeing out of AMD. So double bottom on the daily, absolutely. Neckline is here. Free air overhead at 159.25. Breakouts take us to the bottom end of the gap, 169.75, and the low of this bar at 174.50. The reason I like this so much is because if you look at Friday's daily bar, it's a hammer, but it's supportive over this 3 equal high breakout zone. And on the hourly chart, you can see it as clear as day. Unfortunately, I was more so focused on Tesla, which was plenty fine, but AMD had a beautiful gap, green over red, made the move to the level, is pulling back, and this literally is the concept of a Brigade bolt, right? If we can support that for a higher low, we're looking to make it at least to the equal high, if not exceed it, and go for what? There's that free air breakout I was just talking about, over 159.25. So I like this possible setup as holding for a higher low into the end of day on Friday. Sort of similar to Amazon. It'd be nice if maybe this, gave us the higher low and something like this early in the week to participate off the lows. Risk reward might look something like this, but I think as of right now, the hold so far is solid. If you can get something that maybe does this, maybe you turn this into a double bottom, you can participate over the Friday high and start to look for this. There's a number of different ways to get involved, but I do like the structure that's forming out of AMD here around this 153.50, ideally looking for this to continue in the upward direction. If it's going to be short, it's got to be a lower high underneath 150.75, no ifs, ands, or buts about it based on this consolidation turning back into overhead supply. Let's get into a couple of trade ideas. Let's go back to a daily chart to begin with. LLY, Eli Lilly, is up first on the chopping block, and this is absolutely a short trade idea. So Friday, nasty inverted hammer, huge volume there on the OPEX. You'll notice that maybe this turns into a double bottom, maybe not. I think it's a rejection of this overhead supply. I think that you saw a very lackluster sort of market into the end of the week. I think that sellers stepped up at a very logical area of resistance. So this flat low down here is really my watch. And if you wanted to be even more conservative, not just 895, but under 884 really accelerates through thin structure to the retest of this zone down here. Don't believe me? Let's take a look at the hourly time frame chart. So here's your flat lows. Obviously, you have this shelf as well, but look underneath that shelf. Thin structure, your target's down towards 837.50, 825. So the risk reward's absolutely there if we were to get something that looks like this, again, setting something up that exploits the range as follows. If it's just chopping around in this box, I wouldn't jump the gun on this trade. I'm not looking to position shorts in this box anticipating the break. I want to see this happen literally with the lower high underneath these prior lows in here. If it does decide to break out over 938.75, forget about shorts, but I wouldn't really long it either just inside of this box. If you want the long, it's probably just an all-time high breakout up and over these highs for blue skies. All right, that's LLY. Next up is SMCI. SMCI, of course, is super micro, and this idea has been brewing for a little while now, to be honest with you. Of course, you had the nonsense with the Hindenburg report over here, big short seller, for those who are maybe not familiar. Their positions are likely not on the release of their report in here and here. This is retail getting in on the move or other firms reacting to the report and just sort of the big short. I'm sure Hindenburg is short from whatever, way up here. So if retail is going to get pinched out of this, I certainly think there's an opportunity for longs over 460 to close this area up into 519.25. Let's take a look in the hourly chart here and see what else we can see. So inverted head and shoulders, right? There it is, right shoulder, flat top, over 460. You've got free air. There it is, gappy, thin structure. That's the trade. No longs if we're just consolidating in the right shoulder, and if we break down under 428.37, don't even think twice about longs. Absolutely just step aside, let the sellers do their thing. Obviously, there's plenty of catalyst behind it that can continue to push it in the downward direction. Let's also look at MU. MU's an earnings candidate, as we talked about Wednesday after the close, so please be respectful of that, but it's in a tight little range here. It's very possible that early on in the week, something like this is a thin structure retracement into 93.70. That's over 90.30. So there's an additional trade idea for you in a similar sector. If semiconductors can get in gear, and if the SMH can really, prove itself up and over that 237. Final trade idea that was planned is NKE for Nike. We looked at this on Friday, thanks to Pump Make Up for Losses in the chat. Shout out if you're watching right now. But I think that the daily structure ended up pretty solid, right? If you look at what's happening here, long lower wick supportive over this swing high, didn't close the gap all the way. So what's that an indication of? Sellers not doing their job. Any consolidation over 85 that takes out Friday's high, you've got gap overhead to start thinking about. That's at 93.30. So, I like the setup here out of Nike, and I would probably want to be a player in two spots here, either over the Friday high, which let's just round that off to 90. You guys know the rules. Two spots I would get long. I would look for either a look below and fail of 85 to suggest inverted head and shoulders. I would try to long this pullback right here, or the alternate, let's use maybe green for this, would be we open in the range, we break and Brigade bolt over that high at 87.90, and we're long off of that, looking for the same target up around 93.32. And that's really going to do it for today's episode of the Weekly Watch List. If you enjoyed the video or learned anything new, feel free to let me know down below in the comments section or by giving the video a very simple thumbs up. We hope that you all have a fantastic rest of your weekend. And of course, we will be live back on air, 8 o'clock Eastern time on Monday for the pre-market prep. Hope to see you there. With that said, have a green trading week, and I will see you in the next one.